All right, so given that idea, and I'll keep that paper nearby here, um, we're going to talk about some of the advantages of FIFO and LIFO and their disadvantages as well. Because these two systems are mirror images of each other and polar opposite extremes, the advantages of FIFO tend to be the disadvantages of LIFO and vice versa. So let's start with FIFO. It does correspond to the physical flow of inventory in most businesses, but that's like sort of irrelevant because we don't need our cost flow to actually mimic the reality of the inventory flow through the business. So that's not a paramount importance. So it's irrelevant to some degree, at least from a dollar value perspective, but it does lend a sense of reality to what you're seeing in terms of the numbers and what is truly being sold first. The inventory on the balance sheet closest to current cost, right? Like we mentioned, don't just think of this as in terms of dollar values, but also think of it in terms of how up to date is the information we're putting because dollar value of items is changing pretty rapidly these days, and having the most recent ones make those financial statements even more relevant, so it lends some relevance to the balance sheet. Cost of goods sold tends to be lower. And as cost of goods sold is lower, this tends to be higher net income. Now, is that always desirable? Not on your taxes. And that's why LIFO is so desired in the corporate world. But yeah, FIFO during times of rising prices has lower cost of goods sold, which creates higher gross profit as the most relevant subtotal. But then, of course, we subtract off operating expenses, non-operating items, and all of that. But still, we're starting at a higher gross profit. So it's going to tend to be that we have higher pre-tax income, right? Which means ultimately we could be taxed more. Right? Disadvantages of FIFO, right? Well, the inventory on the balance sheet is current, but cost of goods sold is in those older prices, our older purchases, right? And that creates an issue with matching. We're not really matching the most current prices against, sorry, the most current inventory costs against our sales prices. In times of rising prices, right, this creates more tax expense. As I showed up here, cost of goods sold being reduced by FIFO increases gross profit, which increases my pre-tax income. There's a larger chance of write-downs when we apply a lower cost or market method. That's chapter 9. We will see this in chapter 9, but so kind of tuck it away. But basically, the reason why there's a higher chance of write-downs is because the inventory account, the dollar value, is based on recent prices. And generally, inventory costs rise. So we're putting our expensive inventory on the balance sheet, the most recent inventory, if inventory costs are rising. So that's the advantages and disadvantages of FIFO. Advantages and disadvantages of LIFO. Okay, it really does match the most current trends in inventory prices against our sales this period, right? So we have recent information being placed in cost of goods sold. It is tax advantaged as well because it does increase cost of goods sold. And if we increase cost of goods sold, we're going to tend to reduce our gross profit. And of course, we have other pieces that enter in, but eventually, because we're working from a lesser gross profit, we're going to have lesser pre-tax income, which gives me a boost in recognizing fewer taxes. Now, you might ask, well, why am I avoiding taxes just to not report profit? And that is a discussion for another video. But ultimately, just take it as truth for now. This is alerting to companies. It's tax advantaged during the times of rising inventory costs. There's a smaller chance of write-downs using lower of cost or market because remember the inventory, what the costs that LIFO assigns to my inventory account are at usually lower prices, price points that are from prior periods. It also reduces inventory profits. And I want you to be familiar with this term, inventory profits. It's just the difference between the current replacement cost for the cost of sales and the cost of sales if we used a different method, like FIFO weighted average, LIFO even. Uh, so what it looks at is current sales minus cost of goods sold using only current replacement costs. And we're going to talk a little bit more about that in chapter 9. But we get this gross profit and then subtract off the gross profit that would have arisen from applying LIFO, FIFO, average cost, etc. And that gives me the amount that essentially just arises from my selection of a cost flow method to report cost of goods sold. Disadvantages of LIFO, right? We have lower priced inventory balances, right? So that's coming back to the asset on the balance sheet. At old low prices. Those costs of inventory were less back in the day. And so they're being put on the ending inventory because LIFO assumes we sold the most recent purchases first. It does reduce net income, right? But that's in essence kind of its point because a lot of companies use it because they want to lower their pre-tax income, pay less taxes. That does result in lower net income. There's a potential for LIFO liquidation, right? And so this is going to inflate gross profit. So what's happening here is we're selling through the most recent purchased inventory. And under LIFO, you can have a bunch of old inventory that you might not have ever sold through from prior purchases. And those would tend to be at lower inventory costs, right? So it can potentially reverse the tax advantages of using LIFO. And we definitely will look at this in chapter 9. There can be a greater possibility for some income manipulation if you want to boost cost of goods sold. You can just purchase at the most recent costs, right? Depending on what the most recent costs are doing, that could either boost your cost of goods sold, report higher cost of goods sold if those inventory costs have gone up recently, or if they've fallen recently, you could purchase more to have your cost of goods sold be reported at that now lesser price. So you can time things in order to liquidate the inventory that you want versus you can't really do that without a ton of foresight with other cost flow methods. And if we use a pure LIFO system, a lot of times it's very troublesome to come up with what cost of goods sold is going to be in future price at future times, because you always have to then start to predict not only your own sales and sales volumes, but you also have to start predicting the inventory cost price points as well. So we can start introducing some additional assumptions that can get kind of messy. So that's the big kind of picture between the inventory cost flow methods. And really what I'm wanting you to start to kind of sink into is two overarching ideas. First, they affect both the income statement and the balance sheet in different ways, right? And with different types of information. And the second is that a lot of times the profits we're reporting from these methods are not the most useful, because if we're talking about, well, what would the company, what would the gross profit be if the company repeated these sales tomorrow, then really what is more informative would be, well, what is the current replacement cost of their inventory? Because they're gonna have to buy it all over again in order to replicate those sales, rather than, what is the cost of goods sold under some rational and systematic method that would be reported. So cost flow assumptions divorce us from reality in some ways, and they also have big effects on the financial statements, the income statement, and the balance sheet.